Most financial questions have simple answers, not easy answers, simple ones. Why does your salary feel smaller every year even when it actually goes up? Why does the stock market keep hitting record highs while your rent keeps climbing? Why do some people borrow money to get richer while borrowing makes everyone else poorer? These aren't mysteries, they're mechanics. The financial system operates on a consistent internal logic, and that logic is not neutral. It was deliberately designed. Understanding it doesn't guarantee anything, but not understanding it guarantees you keep getting surprised by the same outcomes over and over again. Why does your salary never feel like enough? Most people have a simple explanation ready. They don't earn enough. If the number on the paycheck were just a little higher, everything would balance. So they work for the raise. They get it. And within a few months, the feeling returns. The money is gone, the pressure is back, and the math still doesn't work. The problem isn't the paycheck, it's what happens to it. When income rises, spending tends to rise with it. Not because people are careless, but because the new income resets what feels normal. You get a $10,000 raise and move to a slightly better apartment. You eat out a little more. You trade the old car for something newer. Each decision seems reasonable on its own. Collectively, they consume the raise before it ever reaches savings. The lifestyle expands to match the income. The gap between what comes in and what feels sufficient stays exactly the same. This has a name, but the name isn't the point. The pattern is, every new income level becomes the baseline, and the baseline immediately starts feeling insufficient. You don't feel richer because you redefine what richer means the moment you arrive there. A person earning $40,000 imagines that $70,000 would solve the pressure. At $70,000, they look toward $110,000. The target moves faster than the salary does. Not because people are foolish, because the mechanism is automatic. Nobody decides to do this. It just happens. The only escape is to treat raises differently from regular income. When spending doesn't grow with income, the gap between earnings and expenses widens over time. That gap is where financial stability actually lives. But the system, advertisers, lenders, social comparison, pushes relentlessly in the other direction. The raise arrives, and the offers follow immediately. A bigger credit limit, a better lease deal, a neighborhood with slightly higher rents. The salary went up. The pressure stayed. Why do banks lend money they don't have? This question sounds like the beginning of a conspiracy theory. It isn't. It's a description of how the modern banking system was designed to work. Here's the actual process. You deposit $1,000 in a bank. The bank is required to hold a fraction of that, typically around 10%, as a reserve. The remaining $900 gets lent to another customer. That customer deposits their $900 somewhere, either the same bank or a different one. That bank holds 10% and lends out $810. The $810 gets deposited. $729 gets lent. Then $656. The chain continues until the original $1,000 deposit has generated close to $9,000 in total loans circulating through the economy. The $1,000 still sits in your account. You can withdraw it tomorrow. But $9,000 in new lending has been created from it. That money didn't exist before you made the deposit. The bank didn't find it in a vault. It was created through the act of lending. This is called fractional reserve banking, and it is not a flaw. It is the system. The entire modern economy depends on money being multiplied this way. When you take out a mortgage, the bank isn't retrieving a pile of cash from somewhere and handing it to the seller. It is creating a new asset, your loan, and, simultaneously, a new liability, the funds transferred to complete the purchase. Money doesn't just move through banks. It gets made there. The risk is built into the design. If enough depositors want their money back at the same time, the bank cannot pay them all. That's a bank run. It's precisely why governments created deposit insurance, to keep people from testing whether the system can actually cover its obligations on any given Tuesday. The number in your account is accurate. The fraction of it physically sitting in reserve, waiting for you, is much smaller than that number suggests. The bank is lending the rest right now. That's not fraud, that's banking. Why does the stock market keep going up when everything else feels harder? In 2023, the S&P 500 climbed more than 24%. That same year, surveys consistently showed a majority of Americans felt the economy was getting worse. Both readings were accurate at the same time. Most financial news treats this as a paradox worth puzzling over. It isn't a paradox. It's just two different scoreboards tracking two different games. The stock market doesn't measure how people are doing. It measures how companies are doing, specifically how profitable they are and how much investors expect them to grow. When a corporation cuts 5,000 jobs, its costs fall and its margins improve. The stock goes up. The workers who lost those jobs don't appear in that number anywhere. Their situation contributed to making it rise. Corporate revenue, earnings per share, and forward guidance move markets. Wages, rent burdens, and household savings rates move lives. The two sets of numbers track different things. They can move in opposite directions indefinitely. This disconnect didn't appear suddenly. It widened gradually. Over decades, as stock ownership became more concentrated at the top of the income distribution, the wealthiest 10% of Americans own roughly 93% of all stocks. When markets rise, the gains flow almost entirely to households that were already wealthy. For everyone else, the record highs on the evening news describe a prosperity that belongs to someone else. This is why economic confidence surveys and market performance so often contradict each other. They're not measuring the same economy. Markets track the financial economy, corporate profits, investor returns, asset prices. Surveys track the lived economy, job security, purchasing power, the feeling of getting ahead or falling behind. The lived economy and the financial economy share a name? They don't share much else. And this is before examining what the market is actually rewarding. When interest rates are low, borrowing is cheap, and companies take on debt to buy back their own stock. Stock buybacks reduce the number of shares outstanding, which mechanically increases earnings per share. The stock price rises. No new product was created. No new worker was hired. The company simply got smaller on paper, in a way that benefited shareholders and nobody else. The market keeps going up because it was built to keep going up, not because the broader economy is getting healthier. The engine runs on profit, not on prosperity. Those two things can look exactly the same from far away. The clearest proof came in the years after 2008. The financial crisis destroyed trillions in household wealth, wiped out jobs, and sent home values collapsing across the country. It was the worst economic contraction since the Great Depression. By 2013, the S&P 500 had fully recovered everything it lost. By 2016, it had more than doubled from its crisis low. Median household income, adjusted for inflation, didn't recover to its pre-crisis level until 2016. And that was the median. For households in the bottom half, recovery took longer and arrived smaller. The market healed in 3 years. The people took nearly a decade. Markets aren't rigged. They're just indifferent. They don't measure suffering and they don't measure recovery. They measure profit expectations, and profit expectations can improve precisely because households are struggling. Because struggling households mean companies pay less in wages, face fewer regulations, and borrow at lower rates while central banks try to stimulate growth. When the economy is bad enough that governments cut interest rates to zero, cheap money flows into assets. Asset prices rise. The people who own assets get richer. The people who don't get cheaper consumer debt. That's not a conspiracy. It's a consequence of how the system is structured. The market going up is not bad news, but it's also not the same news as the economy going up. They're not the same thing, and treating them as though they are is how most people end up confused about why the record high on the news doesn't match the number in their bank account. The scoreboard belongs to shareholders. Everyone else is just watching it. Why does a three-digit number control so much of your life? Your credit score determines whether you can rent an apartment, qualify for a mortgage, and in some states affects whether an employer will hire you. It influences your car insurance premium and your phone plan. A low score doesn't just mean expensive credit, it means expensive everything. Here's how the number gets built. Payment history is the largest factor, whether you pay on time, every time, with no exceptions. Credit utilization is second. How much of your available credit you're currently using, with lower being better. Length of credit history matters. Older accounts improve the score because they demonstrate a track record. New credit inquiries create small temporary dips. And the mix of credit types, mortgage, auto loan, credit card, adds a small bonus for variety. The trap is in the design. To build a strong credit history, you need open accounts. To open accounts, you need to borrow. To borrow responsibly, you need a score high enough to get reasonable terms. Someone with no credit history and someone with bad credit history face the same practical outcome, either rejection or expensive rates. The system cannot distinguish between the person who has never needed credit and the person who destroyed it. Both register as risk. A person who has spent decades paying rent on time, buying groceries with cash, and saving consistently has built no credit score through any of that behavior. None of it counts. The system doesn't reward financial responsibility. It rewards participation in debt. The people who borrow the most, manage it carefully, and keep the balances low get the best scores and the cheapest rates. The people who avoid debt entirely get penalized for the absence of a record. The system rewards borrowers, not savers. Why do some people get richer while they sleep? This isn't a trick question, and the answer isn't luck. It involves understanding the difference between two kinds of income that the tax code treats very differently. Labor income is what you earn by working. You show up, you produce, you get paid. The more hours you trade, the more you earn, up to the limits of time and energy. Labor income is taxed as ordinary income, which means the more you earn, the higher the rate applied to each additional dollar. At higher income levels, that rate can exceed 37%. Capital income is what assets earn on your behalf. A stock portfolio grows because the companies inside it generate profit. A rental property generates cash because tenants pay monthly. The asset works while the owner does nothing. Capital gains, the profit from selling an appreciated asset, are taxed at a maximum federal rate of 20%. Qualified dividends, the income paid out by many stocks, carry the same preferential rate. Someone earning $500,000 in wages pays a significantly higher effective tax rate than someone earning $500,000 from investments. The tax code is not neutral on the question of whether to work for money or let money work for you. The compounding effect makes this asymmetry permanent over time. Capital generates returns, and those returns generate more capital, which generates more returns. The base grows faster than any individual can grow their labor income by working harder. Labor earns income, capital earns more capital. For workers, time is the input. For investors, money is the input. Time has a ceiling. There are only so many hours, and they cost more to maintain as you age. Money has no ceiling. It scales. A $10,000 portfolio growing at 8% annually becomes $46,000 in 20 years without a single additional dollar contributed. A salary growing at 3% annually, after taxes and inflation, barely keeps pace with the cost of staying where you already are. This isn't corruption. These rules were written by legislators, debated openly, and applied consistently. The incentives they create are predictable. Accumulate assets, hold them, let the tax code assist in keeping what they earn. The system wasn't designed to punish work. It was designed to encourage investment. The consequence? That people with capital benefit structurally, regardless of effort, while people without it trade time for money at a higher tax rate, is a feature, not an oversight. Understanding this doesn't change it, but it explains precisely why the gap between earners and owners keeps widening every year, without anyone having to do anything wrong. None of this is hidden. The capital gains tax rate is public. Fractional reserve banking is taught in economics courses. Credit scoring is disclosed by federal law. These aren't secrets, they are defaults. The background conditions that operate automatically unless someone actively learns them and adjusts accordingly. Most people never receive that orientation. They inherit the outcomes instead without understanding what produced them. Why is financial advice almost always wrong for you specifically? Not wrong in the abstract. The basics are accurate. Save more than you spend. Invest early. Avoid high-interest debt. Diversify. These principles are sound. They're also incomplete in a specific way. The problem is that they're designed for someone who already has options, and they're distributed to everyone regardless of whether that's true. Good advice is context-dependent. Generic advice ignores context by definition. Take compound interest, the idea at the center of almost every start investing early argument. The math is real. $5,000 invested at 25 at an average annual return of 7% becomes roughly $75,000 by age 65 with no additional contributions. That's a powerful outcome, but it assumes you have $5,000 that doesn't need to be rent, groceries, car repairs, or medical bills. For the median American household carrying $8,000 in credit card debt at 22% interest, the compound interest conversation is theoretical. You can't grow money you don't have. Spend less than you earn is the most repeated piece of financial wisdom in existence. It's also useless when the gap between what you earn and what basic survival costs is already negative. A person working 2 jobs to cover rent and childcare is not failing to implement good advice. They're operating in a situation where the advice doesn't apply. The council assumes slack in the budget. When there is no slack, the council has nothing to grip. Build an emergency fund requires having money left over after expenses. Max out your 401k requires an employer who offers one and enough income to contribute. Buy instead of rent requires a down payment, a credit score high enough to qualify, and a market where purchase prices haven't already priced out anyone without existing equity. Every piece of standard financial guidance contains an unstated prerequisite that you are already stable enough to execute it. Good financial advice assumes you already have options. When you don't, the advice doesn't fail to work. It never applied. This is the thread that runs through every question covered here. Why does your salary never feel like enough? Because the baseline resets with income and the system profits from that reset. Why do banks lend money they don't have? Because the economy runs on multiplied credit, and the people closest to that creation benefit first. Why does the market rise when your life feels harder? Because the market measures profit, not welfare, and those two things diverge when companies cut costs by cutting people. Why does your credit score control so much? Because participation in debt is the price of admission to affordable credit, and the price is steepest for those who can least afford it. Why do some people get richer without working? Because capital compounds at a rate that labor can't match, and the tax code was written to preserve that gap. These aren't separate problems with separate causes. They're the same logic applied in different places. The system compounds advantage. The more you have, the more you accumulate. The less you have, the more friction every transaction carries. That's not a design flaw. It's the design. None of this means the situation is fixed. Taxes change. Policies shift. Individual decisions still matter within whatever constraints exist at the time. Understanding the structure doesn't remove the structure, but it does remove the guilt. When someone follows every rule, works harder than anyone around them, earns more than their parents did at the same age, and still feels like they're falling behind, the explanation isn't a character flaw. The explanation is arithmetic. This matters because the alternative, that financial struggle reflects personal failure, is both incorrect and costly. People who believe they're failing because of character spend energy on self-correction rather than system navigation. They take out loans they don't need to prove creditworthiness. They avoid investing because they don't feel like they belong in that conversation. They receive the same advice as everyone else and blame themselves when it doesn't produce the same results. Why does everyone say buy low, sell high, but almost nobody actually does it? Because selling low feels like cutting a loss before it gets worse, and buying low requires cash at precisely the moment when markets are falling and confidence has collapsed. The instruction is correct. The execution is a psychological impossibility for most people, not because they're undisciplined, but because fear and cash availability are not evenly distributed across the population. The people with enough reserves to buy during a crash are the same people who already own enough assets to weather it without selling. Everyone else is liquidating to cover expenses. The financial system doesn't malfunction during a crisis. It transfers. Wealth moves from people who need cash now to people who can afford to wait. Every market collapse in modern history has followed this pattern. The asset prices fall. The people who survive the fall buy more. The prices recover. The distribution has shifted, and most people didn't notice because they were watching the headline number, not the underlying transfer. The 2008 crisis wiped out more Black and Hispanic household wealth than any event since the Great Depression. The recovery that followed set records. Both facts are true. They describe different populations. The answers to financial questions are almost always simple. Not comforting? Simple. The salary never feels like enough because enough isn't a number, it's a gap, and the gap is profitable. The debt exists because the economy requires it. The market rises because profit rises, not because lives improve. The credit score controls access because the system was built to reward borrowers. The wealthy get wealthier because capital scales and labor doesn't. These answers have been available the whole time. They just weren't in the brochure. These are the mechanics. They operate whether or not anyone explains them. The only variable the explanation changes is whether you're surprised when the outcomes arrive. Financial literacy isn't a cure. Knowing how the credit score works doesn't make it go up faster. Understanding how money is created doesn't add any to your account. The knowledge closes the gap between what's happening and why. That gap is where most of the frustration lives. The system feels random until it's legible. Once legible, the frustration doesn't disappear. It stops feeling personal. The answers were always simple. The system just needed you not to ask.